Have you ever considered the possibility that someone might take greater risks simply because they know they're protected? This intriguing idea lies at the heart of a concept in economics known as moral hazard. Moral hazard is a situation where one party in an agreement engages in risky behavior because it knows another party will bear the cost of that risk. In other words, it's a situation where the burden of risk is not shouldered by the one who caused it. To make it simpler, imagine lending your umbrella to a friend. You might think twice before doing so, right? Why? Because you're aware of the risk that your friend might not take care of it as you would. This is a simple manifestation of moral hazard, but when moral hazard happens in the economic world, it can lead to significant issues. In finance, insurance, and healthcare sectors, its ramifications can be far-reaching and complex. Take the financial sector, for instance. The global financial crisis of 2008 is a classic example of moral hazard. Many large banks and financial institutions took excessive risks, knowing that if things went wrong, the government would step in to bail them out. They were right, and this led to a massive economic downturn, affecting millions of people worldwide. Now, let's look at the insurance industry. When people know that their losses are covered by insurance, they might engage in riskier behavior. For example, a person with car insurance might drive more recklessly, knowing that the insurance company would cover the damages if an accident occurs. The healthcare sector is not immune either. A patient with health insurance might opt for an expensive treatment because they know their insurance will cover it, even if a less costly treatment could be just as effective. So, how do we mitigate the risks of moral hazard? It's a tricky question, and there's no one-size-fits-all solution. However, policy, regulation, and ethical business practices play a crucial role. For instance, in the financial sector, regulatory bodies can impose rules to limit risky behavior. In the insurance industry, companies can introduce deductibles and co-payments to ensure policyholders share some of the risk. In healthcare, doctors can educate patients about the most cost-effective treatment options. In conclusion, moral hazard is an intriguing concept that has profound implications for our economy and society. It occurs when someone takes a risk, knowing that someone else will bear the cost if things go wrong. It's a pervasive issue in finance, insurance, and healthcare sectors, and mitigating it requires a combination of policy, regulation, and ethical business practices. Remember, economics is not just about numbers and markets. It's also about behaviors and incentives. And understanding concepts like moral hazard can provide valuable insights into why people and institutions act the way they do.